Welcome back. So let's continue from where we left in the last video. Let's also talk about modern portfolio theory. The concept of diversification has been around for as long as the time of portfolios has been there. However, it also has a very strong intuitive appeal. The main message that the modern portfolio theory tries to give is that investors should not only hold portfolios but also focus on how individual securities in the portfolios are related to one another, something that I talked about previously regarding correlation. That means individual securities should not have a very high correlation, otherwise your portfolio will not be able to provide you a good diversification benefit. So individual securities in a portfolio should have very low correlation to one another. Let's now talk about the various types of investors. Portfolio managers may be employed or contracted by a wide variety of investment clients. These clients can be grouped into either individual investors category or as institutional investors. Our initial distinction is between management of private wealth of individual investors and investment management of institutional investors. Let's talk about individual investors first. Individual investors have a variety of motives for investing and constructing their portfolios. The motives of individual investors can be segregated into short-term as well as long-term. Short-term goals can provide for requirements such as children's education or saving for a big purchase like a car or even a house. Long-term goals would include retirement goals, that is, investing to provide for an income at the time of retirement. One of the major concerns of individual investors is the retirement requirement or retirement goal. And it is also the focus on a lot of portfolio managers who manage funds for individuals. Now, some individual investors may focus on growth, that is, they may focus on capital gains. They want the value of their investment to increase over time. However, there may be still others who would focus on income. That is, they may not be so concerned about the growth in value over a long term as with the current income that is derived from those investments. And it is very intuitive that the growth motive will be for those investors who are young and who have a long time horizon. Plus, they don't need the funds immediately that they are investing. They are looking for a retirement goal or something like that. At the same time, if I talk about those investors who are interested in the income goal, those would be the ones who do not have a permanent stream of regular income anymore, and these could be the retired clients. So they are not so much interested in capital growth, but they do want a steady stream of income. So the first category of investors, those who are interested in growth, could invest in long-term securities which do not pay regular dividends or incomes but rather concentrate on growth. While the investors who are interested in, say, income should focus more towards dividend-paying stock and fixed income securities that can provide them a steady stream of income. Let's now move on to individual investors and to institutional investors, and their requirements. There can be many types of institutional investors, including but not limited to defined benefit pension plans, university endowments, charitable foundations, banks, insurance companies, investment companies, and the like. Institutional investors are major participants in the investment market. When we talk about defined benefit pension plans, let me tell you that these are the pension plans that guarantee a defined benefit to their members, and therefore they are concerned with a good return on their income, and they are also usually having a long-term focus because they want to ensure that they should be able to pay off the liability of the pension when it becomes due. The second category is university endowments. Now, university endowments are establishments that provide continuing financial support to university and certain set of students in terms of scholarships. Next would be charitable foundations. Charitable foundations invest donations that have been made to them for purposes of funding grants that are consistent with the charitable foundation's objectives. Similar to university endowments, many charitable foundations are substantial investors in the investment markets. Now, both university endowments and charitable foundation would not be concerned about capital growth. They would be concerned about something which is called capital preservance. That is, they want to ensure that the value of the capital does not fall due to inflation. So they want an inflation protected return so that the real value of the capital is sustained, and they want sufficient income to ensure that they are able to fund the scholarships or the objectives of the foundation, as the case may be. Next category of institutional investors is banks. Banks typically take out loans, or the individuals invest their money in banks. So banks have to find suitable ways of investing this cash to ensure that they have sufficient return so that they can pay off the interest on the loans that they have. Plus also they should be able to make out sufficient profits from that. The next category would be insurance companies. Now, insurance companies get income from premiums. So they collect premiums for insurance policies. However, again, they want to make sure that they have sufficient funds to be able to pay off a claim when it comes due. Next, we have investment companies. Investment companies manage mutual funds, are also major institutional investors in the financial markets. Lastly, I would like to talk about sovereign wealth funds. Now, sovereign wealth funds, as the name suggests, are government-owned investment funds, of which many are quite sizable. So they can be one of the biggest institutional investors in a market. Now, this is a chart which gives you a summary of investment needs by client types. I would expect you to quickly go through it. The various client types described here are individual investors, defined benefit pension plans, endowments and foundations, banks, insurance companies, and investment companies. So as you can see, the individual investor's time horizon really varies from individual to individual. Their risk tolerance again varies from person to person. Their income needs as well as liquidity needs all vary from one individual to another. Next is defined benefit pension plans. The defined benefit pension plans usually have a long time horizon. They typically have high risk tolerance, and they are high. The income needs are very high for mature funds but low for growing funds or younger funds. And the liquidity needs are typically quite low for new funds and high for the mature funds. Let's now talk about endowments and foundations. The time horizon is very long when it comes to investors such as endowments and foundations. The risk tolerance is also typically high. The income need is just sufficient to meet the spending commitments and also to maintain the inflation protected value of their capital, and their liquidity needs are typically low. For banks, the time horizon is usually short term. The risk tolerance is quite low. The income needs are high as they need to pay interest on deposits and operating expenses. The liquidity needs for banks are also high because they need to meet repayment of deposits. For insurance companies, the time horizon would be short term for property and casualty insurance and long term for life insurance. The risk tolerance would typically be quite low for insurance companies, and they are also covered by various regulations in several countries. The income needs are also typically low. The liquidity needs are just those for meeting the claims as they arise. Next would be investment companies. For investment companies, the time horizon really varies from fund to fund. The risk tolerance, again, the risk tolerance and income needs also vary from fund to fund, and the liquidity needs are high for investment companies, especially those which are open-ended, because they need to meet redemptions. Thank you very much. We'll continue with the next subtopic of this reading in the next video.